Hello and welcome to another edition of the Global Markets Technical Outlook, this time for the end of quarter one of 2024. Normal disclaimers apply as we take the quote this time from Baron Rothschild, who says that you should buy when the cannons are firing and sell when the trumpets are blowing. And of course, he was talking literally back when he wrote this during the Napoleonic Wars, but we can certainly take it metaphorically these days. If everyone is bullish, then maybe we should be a little bit cautious, and vice versa. So keep that in mind as we dig into the charts, as first of all kicking off as we do with the US stock market. And well, it's just a beautiful looking uptrend, this chart. It's well within its lower and upper trend lines. As you can see, this is on a log scale. It's actually broken out above that old high there, which we'll dig into in a moment. But there's a lot of stuff being written about this market. It's overbought. It needs to, the next move is going to be lower, or the whole thing's going to collapse. But you'd have to be looking at this chart upside down really to come up with that sort of conclusion. This looks like a very bullish chart. It's making higher highs and higher lows, and there's certainly nothing that I can see on this chart that warrants any sorts of bearishness. As we dig into the weekly chart, you can see we have this lovely looking cup and handle as the correction bottomed out there, and then we got that final low before it went through the old peak, and now it's crossed through that 5,000 level. It's starting to look a little bit extended to the upside, so we shouldn't discount that we'll get a pullback, but it certainly doesn't look like it's ready to top out in any large fashion at this way. I think we'll see just a normal correction, and then the probabilities favor the upside at this point. On the Ichimoku chart, we can see it's just very bullish, isn't it? We've got the price and the Chikou span, or the lagging line, both well above the cloud, and the cloud providing support round about that 4,400 to 4,600 area. If we dig into the market internals now, we can see that on the bullish percent index that we're sitting at a very healthy 72% of S&P 500 stocks currently bullish. The other thing to take away from this chart is that if you look back here through 2021, when the bullish percent index was diverging away from the price action, and that kind of is a kind of long-term or a sort of medium-term warning of the market becoming overheated because there's less participation, so you get a few stocks pulling the whole market up. Whilst a lot of the talk has been about the Magnificent Seven, cornering the all the upside in the market, the participation, as you can see, is actually very broad. So there's funds being redeployed to the other stocks in the index, and they're all heading up, or 72% of them at least at this stage. And these sort of equal peaks that we're seeing in the bullish percent index speak to what looks to be a very healthy uptrend at this stage. Stocks above their 200-day moving average is also giving us a similar print here, around about 70%. Which again is healthy, and we're seeing peaks top out at more or less the same page. We're not seeing any sign of divergence with this indicator becoming lower as the market moves higher. So once again, that speaks to the health of this uptrend at this point. On the discretionaries versus the staples, this is also moving up, so that's agreeing with the market. There's no divergence once again. That tells us that we are this is a healthy, well-supported uptrend. We would expect discretionary stocks to be outpacing staples when the mood is in the economy for things to become better, and that usually means a better upside for the broader market. Same on the semiconductors. If we compare their ratio to the S&P 500, semiconductors are outpacing the broader market, and that's really to be expected, given that the market leader at the moment is Nvidia, and that's basically their wheelhouse is producing chips. So we would expect the semiconductors to outpace the broader market, but the semiconductors are also a leading indicator of where the market may be headed, because the semiconductors industry traditionally is more speculative, relies much more on a strong economy with more things being built and sold. So once again, that's a good sign for the market. And the advanced decline line, which is actually showing a very similar pattern to the market. You can pick out that cup and handle here, and we're seeing a similar cup and handle here in the AD line, and it has broken just above that old high there. So again, once again, that's a positive sign for the market that we're seeing advancers progress. And another way we can look at that is by looking at the new highs versus new lows, and you can see through this uptrend that we've been in since around about November last year, you can see the new highs stocks, the number of new highs in this is across the NYSE this time, are far outweigh the number of new lows. In fact, we're not seeing hardly any new lows being printed. So once again, that's a healthy sign for the market. There's lots and lots of stocks making new highs and very few making new lows. And it's, we would expect to see the new lows starting to print as the market nears a high, as it did back here in 2023, but currently there's no sign of that at the moment. And we're only a couple of months, 2.5 months into the year so far, but already we can see that the two big indexes, the S&P and the NASDAQ, are both up about 7 or 8% for the year, which is phenomenal. I mean, that's their sort of long-term annual average, and it's already done that in the first 10 weeks of the year. And then we've got the Russell bringing up the rear at around about 2%. The Russell obviously being the small caps there. The Russell doesn't have these big growth stocks like Nvidia and Google and Apple and so on. Those are all contained in these two indexes up the top here, and so that's why it's a bit of a laggard at the moment. But that just shows you that the differential, if you like, that the big growth stocks, the Magnificent Seven, the tech-heavy sector, AI boom and everything is actually contributing to this current phase of the market. One of the big talking points of the last month or two has been the inverted yield curve. The yield curve continues to show an inversion, and yet there's no sign in the market or the economy or anywhere else that there's a recession on the horizon. And this has got some people scratching their heads, and we're seeing headlines like the inverted yield curve no longer reliable. There's other commenting that perhaps it's just a sign that the Fed are holding the rates too high on the cash rate, and that needs to come down to disinvert this curve. I'm not so sure. I actually went back and had a look. When was the last time we saw an inversion like this? And if you go right back to 2006 here, around about October in 2006, we had an inverted yield curve, but we were well ahead of the next recession, which came more or less towards the end of 2008. So we're looking at, in that case, at least there was like a 2-year lead time. Often people talk about an inverted yield curve being a sign of recession in the next 18 months or so, but I'm just wondering, are we just very, very early here with this? I mean, we will get some market correction, large market correction, possibly bear market at some point down the track, but there's no sign of it on the horizon now. So I think we're just this is just a very early warning signal, and it's not that it's broken, it's just very, very early at this stage. Nevertheless, the New York Fed are putting the odds of a recession in the next 12 months up at around 61%. So that's slightly better than a coin flip. So make of that what you will. You can also take in the fact that this is the highest reading that we've had on this chart since 1980, which is a long, long time ago. So one to watch. Over on the sentiment indicators, the put-call ratio, middle of the range, really. We're not seeing this overheated down, in this bullish extreme where we would expect it to be if the market was really, really motoring towards a top. Where that would be a sign that there was call buyers becoming more aggressive and put buyers less aggressive. But we're really in the middle of the range here. So there's no sign of overheating on that indicator. And same goes for the VIX as well. We came as the market started to motor up through this bull market, really since the sort of tail end of 2022 there. You can see the VIX consistently falling. Every time it peaked, it got sold down. And now there's just very, very little appetite for protection. There's, the VIX basically is priced by people buying S&P 500 puts or by buying VIX futures to hedge their portfolio. And if there's no demand for that, the price of the VIX falls, and that's exactly what we're seeing. And a low VIX usually is associated with a market moving higher and higher, and that's exactly what we're seeing at the moment. So no sign there that we're near any sort of top, or that there's any kind of stress in this market at this point. And on the seasonality, this is the annual seasonality. We can see that we haven't really, this is the year to date of the S&P down the bottom here. We're not really starting off by taking any notice of the cycle. In this case, we've had a very bullish couple of months, whereas we would expect the start of the year to be more choppy. But what's interesting, as you can see here, we're actually heading in to the most bullish time of the year. In fact, if we look at the individual annual average, the individual monthly returns on average, we can see that we're midway through the one of two most bullish months that there is. March, we would expect 1.1, April 1.9, which is the third most productive month of the year. So having already come this far in terms of gains that the indexes have made, it will be really interesting to see if that can be sustained through these 2 months at least. And then we usually hit the sell in May and go away period. So, but it's looking rosy, at least for now, given the seasonality. We are, of course, in a US presidential election year, so we're into the fourth year of the cycle. And here we've got the standard cycle, which is this blue line here. But when we have a sitting president running for re-election, it tends to follow much more this green line here, as you can see. And we have obviously started off, this is the year to date, down the bottom here, we've started off very bullishly. But according to the cycle, we can go into a little bit sideways chop through March, April, May, June, and then out of the back of July, it tends to become a bit more bullish. So we'll certainly keep an eye on that one. It's obviously quite early in the year to make any conclusions about where we're sitting. On the decade cycle, on average at least, is very choppy up until the very end part of the year, where it tends to get a little bit more bullish. So we certainly haven't been following that yet, but again, we'll keep an eye on it as the year progresses. And on Calvert Clark's pressure cycle chart, we can see that year 4 tends to be one of the poorer of the positive months. In fact, it's only this is the second worst of the ones that are indeed positive. So again, we've already made our average for the year. So for it to follow this chart, it would have to either go sideways or pull back from further gains. Again, we'll keep an eye on that as the year progresses. Over on the Australian stock market now, and the ASX 200 finally made that breakout above 7,600. It's been a long time coming. We've been stuck in this sideways pattern since 2021. That's just this little bit here, and then you'd have to go back to 2020 just prior to the pandemic to see the break from the old 2007 high there. So it's certainly been motoring, but we have this lovely looking ascending triangle, the break above, and now the question is, can it hold the 7600 level? The month so far has been a little bit up and down, but we've obviously not completed the month yet, so we'll have to see where that ends up. But 7600 is the current level that is key for the ASX 200 to hold. On the weekly chart there, you can just see that sideways chop as we kind of moved up and down through that period between 2021 and now. And now we've finally got, boom, the breakout. And, I just wonder, will it come back and just tag that 7600 level, and then that might be where it bounces and moves higher, or do we fall back into the pattern? I think we'll know the answer to that certainly in the next 2, 3 or 4 weeks. On the Ichimoku chart, though, it's very, very bullish for the ASX 200. Up, the price is out. The Chikou span is well above the cloud, and we're seeing that cloud support down around 7200 or 7300. And just comparing the ASX 200 in green here to the other indexes around the region and the US, we know that the S&P's done 8%, but the Nikkei has been charging ahead so far this year. It's done 16% for the year so far. We're more or less in line with the Indian Nifty, and then we've got the Hang Seng coming in at just about scratch for the year. Interesting chart, this one, to occasionally look at, which is the ratio of the ASX 200 versus the S&P 500. And since the start of 2023, it's lost about 21% on a relative basis. In other words, the S&P 500 has outpaced the ASX 200 by roughly 21% through that period. And of course, that's mainly because of these large tech growth stocks that the S&P 500 has versus the ASX 200, which is much more sort of income-driven index. It doesn't really have many of those big growth stocks, but that's always an interesting one to watch. Perhaps a good pairs trade in there even. On to the currencies next, and the US dollar index. Well, we saw that sort of big push through that 103 level as everybody got excited thinking that rate cuts were coming in 2023, 2024. That's sort of been the appetite for that has become more and more tempered, and we've seen the dollar index fall back there. But it's just holding around about that 103 level. If the Fed do start cutting, or the expectation rises that we'll see multiple cuts, we would expect this market to probably pull back a little bit more. Otherwise, if that becomes less and less of a likely outcome, then perhaps we see another bit of a kick up here. On the Aussie dollar, it is trapped below that 70 level and just trading sideways, really. It did try to recapture it, as you can see there, back at the start of 2023, got pushed back quite quickly, and it's pretty much gone sideways since then. I think a tag of this 60 cent level would not be a surprise, but getting back above 70 probably seems a little bit unlikely unless we see the US dollar falling. On the euro, kind of a similar story. We got that bounce as it sort of had a near-death experience, dropping through parity there for a couple of months, and then we recaptured that key 105 level, and once again it's just kind of moving sideways from there. I think everybody's just waiting to see what happens with the central banks this year as they weigh up inflation and interest rates. And the Japanese yen, however, is sort of victim, if you like, of the massive carry trade that's going on at the moment. The Japanese interest rates holding around about zero, and every other interest rate in the world is higher. So this is the yen versus the US dollar, which has a large differential in terms of its rates, and so we've got this massive carry trade just pushing the yen lower and lower. And you have to go back a long way to find this next support level I have drawn in here at 0.0062 dollars to the yen. In fact, you have to go all the way back to 1990, way back here. So that would be significant if it managed to reach down and tag that level. But that certainly is the level to watch at the moment. But the big news in the last month or two has been the rise of Bitcoin. And if you were lucky enough to pick yourself up a Bitcoin for a measly $15,000 back in October or November of 2023, you would be sitting on a 400% P&L rise in a little over 18 months or so. So that's been a very nice trade, and it's just surprises all the time. It just gets more and more volatile, and you can see the upside volatility is actually way more than the downside volatility. So 32,000 was about the last key level. It's just kind of blasted through 40,000, 50,000, and now it's back through the old highs at 69,000 and trading up around 72 at the moment. So very, very bullish. Obviously starting to look a little bit overbought at the moment, and we would expect a pullback. But there's people even talking about 100k this year. So let's see. And finally, wrapping up on the commodities, oil is falling. We have this what's starting to look like a descending triangle here. We got 63 is the key level to the downside, and it's we've certainly got 3 touches there and possibly a 4th touch in here at the moment. So we probably shouldn't be surprised if we see it hit down around 63. It's not looking super bullish for oil right at the moment. Also not looking super bullish is wheat, which has been falling really since the Ukraine war outbreak pushed the price way up, and since then the supply issues have largely been ironed out, and we're seeing that now start to fall. So 427 the downside level for wheat. On copper, well, it's been stuck in this little sort of symmetrical triangle shape that it's been consolidating within. We've had a bit of a bullish move just in the last month or so we'll see if it manages to break out of this area, and could it head back for this 465 area. So looking sort of mildly bullish, let's call it, for copper at the moment. Iron ore, however, is a little bit of a different story. It's sort of fallen down between that couldn't quite keep that 130 level that it captured briefly through the tail end of last year. It's now back below that level and back into the pattern. Obviously, the Chinese slowdown is a big part of this story here. And we're kind of back in between the level of 80 and 130 for iron ore. But the big news on the metals has been gold, which punched through its old resistance level at 2087 there, and it's now looking very bullish as it blasts off through that level. So it was a lovely kind of Darvas box trade, if that's your thing. It's stuck between these two levels, and now it has convincingly broken through that level. Again, we're only halfway through the month, so we'll have to see if that manages to hold. But if we can get a couple of closes on the monthly chart above gold, then I think the upside would have to be favoured. So just to summarize, US stocks obviously looking very bullish. They're riding all-time highs at the moment. It's maybe starting to look a little bit extended to the upside, so we shouldn't discount a correction coming in, but my sense is that any corrections will be bought into, and we should see further highs going forward. The ASX 200, well, we've had that breakout against above the old highs, but will it hold? Will the Aussie be able to hold up at that level? And we'll know the answer to that quite quickly, I think. On the currencies, most of them heading sideways, but the yen still falling, and Bitcoin is the sort of granddaddy that's doing all the heavy lifting at the moment to the upside. And on the commodities, gold, we saw that breakout there, but just a demand slowdown in the economy elsewhere is probably tempering the prices of oil, etc. And if you're interested in having a look at the stuff I trade, smartsystematictrading.com. Monterey is a rotational strategy that trades NASDAQ stocks. It's up 22% so far this year, and as we know, the NASDAQ index itself is only up about 7%, so very happy with this one so far. And then Dolphin's a little mean revert US ETF strategy, and it trades at a 90% win rate. It doesn't trade often, but trades about 15 or 16 times a year, and a 90% win rate. I'm quite happy with that one too. So anyway, if you want to have a look at the stats on that, jump on smartsystematictrading.com and let me know if you have any questions. That's it from me, folks. I wish you all the best for the next quarter. Good luck, good trading, and bye for now.